Hey everybody, Chuck Barone here. Monday, August the 1st, 2022. We turn the page on a very eventful month of July, moving into August and the dog days of summer. I got a feeling that this month is going to be at least as eventful as the last one was. There is just so much stuff going on in the world of finance and the economy right now. Today's stock market. Today's market wrap real quick. The stock market today was down marginally, basically a flat day. I think the stock market taking a little bit of a breather from a massive rally last week. Lots of new data coming in. I think the market's going to take a little bit of time to digest that. We'll see how earnings go. There's a big week for earnings this week. Let's see how these earnings look. I got a feeling that there might be some surprises in earnings, and the stock market might be in for a little. The correction is well overdue. We're going to wait and see when it actually happens. In the bond market today, St. Jerome of Jekyll Island strikes again. It's just an amazing thing here. You have a 10-year today, the 10-year Treasury at 2.60. Guys, this is just beyond belief. Where you have an overnight rate, the Fed funds rate, at 2.35% and a 10-year Treasury rate at 2.60. There's 25 basis points between them. Are we going to see an inversion of the 10-year with lower rates than overnight rates? I guess in this world we're seeing here this new world of who the hell knows what. I guess anything's possible. I don't know if that's ever happened before, but I've never seen it in my lifetime. Bond market rallying like crazy. I guess there's just a lot of people that want to buy bonds. And that's real believable. The dollar today down at 105.43 on the dollar index. The dollar's kind of been losing a little bit. It was up around 107 on the index, which leads to a nice little rally for gold and silver. Silver sitting today at 20.44, basically unchanged for the day. Gold at 17.72 per ounce. Metals are looking like they're poised for a run-up as this dollar comes down a little bit on the index. Oil was under pressure today. West Texas Intermediate closing at 93.43 per barrel, down about 5%. That's a pretty big move. Natural gas holding tight, sitting at 8.826. Basically flat for the day, and natural gas has had a big run up, so it's kind of consolidating gains. Bitcoin today down just under 23,000. I think we're kind of getting back into that trading trough here. I thought it looked like we were going to break out to the upside, but now we're making our way back down into that trough. Hopefully this is just a consolidation, shaking out the week, and Bitcoin might be poised for another move up. We'll see where this goes. In recession signals today, all kind of stuff coming out, guys. The media and the political class want to completely bullshit us that this recession isn't real. It's technical recession. It's anything but what it really is. And if they even come close to admitting it's a recession, you never hear policy as the reason why we're in a recession. It's always something else. The supply chains or the Russians or this or that or some other bullshit. Guys, it's always the same reason. It's bad policy. Bad fiscal policy, the government running these tremendous deficits every year, spending money like they actually have some. And the Federal Reserve with their crappy monetary policy, keeping rates super low for way too long, causing this giant inflation in real estate, which then caused everything else to inflate all around it. But there's a lot of signs of this recession and what is going to actually happen. So don't believe these yutzes. We're going to tell you what's going on here. Let me give you some of the stuff I've been reading, some interesting stuff. Here in Las Vegas, this is by own eyewitness, median prices for houses fell $17,000 just last month. And they're on the way down even further. People still cannot buy at that level. I think we're in the very beginning of a big real estate correction. And it's going to happen not only here in Las Vegas, but it's going to happen all over this country. I think what's going to ultimately happen is we're going to give back a probably all of the giant gains we had over the last year or so, and maybe even a little more of the year before that's gains. It's going to, I mean, this is really just a return to normal, guys. Houses going up $100,000 in a year is not a normal real estate market. So I think that reverting back to prices that are normal, quote unquote, or tolerable to get first-time buyers and people back into this market, while it's not so great for the people who have counting on this equity and people who will actually go upside down on their houses owing more than they're worth, it's going to make for a healthier real estate market. Houses are not supposed to move in price like that. People in the industry, myself among them, would prefer to see a much more normal 2, 3, 4% increase year over year, steady climb, rather than these wild trajectories. And now that's all going to come back down to earth, guys. Other interesting news, Amazon today announces it's pausing 18 more warehouses. So they were planning on building warehouses, these giant warehouses all over the country. Now they've already pretty much canceled out 40 of those warehouses. Now Amazon controls a vast part of e-commerce. I mean, I want to say over 65% of it, the total of e-commerce on the internet. If they're going to be stopping their expansion, what does that tell you they expect to happen with their sales? You think sales are going up? That's why they're canceling this? No, they can see what's happening. They're going to cut their expenses, and this warehouse stuff is easy. Next is going to be people, and you're going to see all of this coming. We have, thanks to the Fed intervention in the bond market with these 10 years at unbelievable rates, mortgage rates are actually coming back down in the face of the Fed raising overnight rates. Today, government rates, FHA and VA loans, sitting at about 5%, down from over 6 just about 5 or 6 weeks ago. So this market's just all perverted. Who knows what comes next? Does the market come back to its senses and rates move back up? Does this bond buying, carry on and rates continue to come down? I don't see how that's going to be feasible for the long term, but over the course of this show, we're going to keep you guys updated on it. Another thing I wanted to bring up is everybody can expect some stimulus next year, or even this year, depending on how bad things get. California is already planning stimulus of checks up to $1,050 for the citizens in California. If you'll remember the last 2 big recessions, the Bush recession and the Obama recession, both presidents did stimulus, but they labeled it a tax rebate. So basically, they gave you basically an advance on some of your tax refund, and that was kind of a crappy one because a lot of people, myself among them, had to actually pay that stimulus back when they filed their taxes at the end of the year. So, that kind of they give and they take away in that particular case, not like California has been doing or they did during this pandemic. Today we had Fed member, Open Market Committee member, and the president of the Federal Reserve Bank in Minneapolis. We had Neil Kashkari out yesterday talking. And I don't know what the Fed thinks they're going to do, sending these guys out to talk for them, because I don't know if he added any real comfort or certainty to these markets. Let me give you some quotes from Neil. Kashkari said that the Fed does not care about recession. Fighting this inflation is their number one priority. And so far, here's where the quote starts, so far inflation continues to surprise us to the upside. Really? Do you not buy groceries? Do you not put gas in your car, Neil? I mean, it's just unbelievable how out of touch these knuckleheads are. He said, quote, "We are a long way away from achieving an economy with 2% inflation." He wants, that's obviously the Fed inflation target. They're talking about getting back there. I think that everybody, some of these Fed Reserve members themselves, underestimating what it's going to take to bring inflation back down to that number. He said, now they're trying to talk the recession. He pointed to job growth, but he called tech layoffs, which we've been talking about that on the show too. He called those the canary in the coal mine I think as a way of signaling that more unemployment is coming. He said inflation is spreading throughout the economy. And there was a major poll done by Primerica, and some of the results of this poll, guys, are just astounding. Listen to some of these numbers. 66% of Americans believe that a major recession is right around the corner. This is up from 48% last month. So over the course of the last month, a big amount of people now are starting to see this recession real. They're starting to feel this recession. 82% of the people polled said inflation will have a negative impact on their purchasing power in the next 6 months. And that same number, 82%, said they expect inflation to get worse over the next 12 months. Now that's a big red flag for the economy, guys. Remember, in the United States, in the U.S., in our economy here, okay, 2/3 of our GDP is all about consumers, consumer spending. When consumers are talking about recessions and inflation getting worse and all of that stuff, that does not bode well for consumer spending. Here's some more interesting stats. Over 61% of Americans are now living paycheck to paycheck, meaning they have no ability to save or do the extra things they want to do in their lives. People, that is roughly 157 million adults, working adults, who can't, they get paid on a Friday and they're tapped out by Monday. It's not good, guys. Almost more than 50% of adults have already added debt over the course of the last 3 months. And their savings are falling. People actually managed to put a little bit of money away during the pandemic because they were getting these stimulus checks. There wasn't as much opportunity to spend money, so people were saving. Well, now those savings are little by little getting eaten up in this recession and this inflation. 66% of Americans believe that this major recession is coming, up from 48, I already said that. 82%, 75% say that their earnings cannot cover the cost of living. This is 3/4 of Americans who are saying their earnings from their work cannot pay the basic necessities, your basic primary goal, your basic primary expenses: shelter, food, gasoline. So what does that say about consumer spending on the extra stuff? Well, let's talk about that. 70% of those polled said they're going to be cutting back on restaurants and takeout food. More than 70% said they would skip upgrading on their phones, on any of their tech gadgets, iPads or whatever. Almost 30% of the people polled added credit card debt in June. That is the highest number since they started tracking credit card debt. Almost 1/3 of the people with credit cards added debt in June. And the sad thing is, this extra debt is not to go to Neiman Marcus and buy something fancy for yourself, okay? It's to buy food. It's to put gas in your car. The base, not luxuries, no. Now they're adding debt on just to pay the necessaries of their day-to-day living. Anyone who would believe that this recession and this inflation aren't real, I liken it to the kid with his fingers in his ears going la 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 la, refusing to listen to you. Because you pretty much have to live in a hole in the ground to not see all of this all around you. Now, today I want to just close out real quick with this misery index. I think you're going to see a comeback of that. And how they measure the misery index is they take the unemployment rate and the inflation rate and they put them together. Okay? So right now we have an unemployment rate really low, like 3.6%, and we have an inflation rate of 9.1. So that misery index combined would be 12.7 on the misery index. To give you an idea of where I believe we're going, in 72, when they first started computing this misery index, it hit a high of 18. In 79, right when Paul Volcker was taken over as Fed chairman, it hit the all-time high at 20. Imagine a 20. That's like 10% unemployment and 10% inflation. It's just unbearable. I think that sitting at 12.7, we're going to, before this is over, we're going to see our misery index get up to this 18, 20 range, which is where these misery indexes end up in inflationary recessions. Anyway, guys, that's all I have for the day. I really appreciate your support for the channel and supporting our videos. I apologize for last week's little snafu, missing a couple of days. It couldn't be helped, but I'm back at my desk today, as you can see, alive and well in 100 bajillion degree heat in Vegas. Don't let all of this stuff get you down, guys. You know what to do. Save your money. Invest it conservatively. Spend your money judiciously. Be very thoughtful about how you spend your money. And hunker down, because when this is all over, and this will end, there's going to be a lot of opportunities to buy everything, because it'll all seem like it's on sale from these prices. Again, guys, we appreciate your support. Thanks a million for your likes, your shares, your comments and questions, all the subscribers. Make sure to hit the bell so you get your notifications. Appreciate your support, and we'll see you again tomorrow. Thanks.